7% plus annual cash flow for life, or 5.47% AAA rated through retirement. What's better? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well, and that your financial journey is also off to a good start for the new year. As promised, today's video is part one of our mini-series on how to build an income strategy in 2026. It's also a sneak peek into what we will be covering in greater detail in our brand new VIP member community this year. And as we already discussed in our 2026 market outlook, link below for your convenience, Fed funds rate forecasts for this year vary widely, even from the folks at the Fed, as their own projections show, from as low as 2.1% to as high as 3.9%. While no one really knows exactly where short-term rates will be at the end of this interest rate cutting cycle, what's clear is that the high T-bill rates that many of us had gotten used to since 2022 are coming down, which is why it's so important now for you to understand what other safe and stable income options exist out there and which may be best suited for you. Here are the three topics I'll be covering today. 1. How should you think about building an income stream in 2026? 2. What are Diamond NestEgg's 7 safe and predictable building blocks for income that every investor should consider as the foundation for his or her portfolio? And 3. What's our perspective? Let's dive in now, folks. How should you think about building an income stream in 2026? Many, if not most, of our Diamond NestEgg members and super savers have retirement in mind when they initially embark on their financial journey with us on this channel. When we're younger, we typically start by building and growing our wealth, often with a focus on equities. And over time, we rebalance our portfolio towards bonds and other safe income-generating assets as we approach retirement. The closer we get to retirement, the more important one question becomes, though. How can you build a safe and predictable income stream that can replace your paycheck and carry you through retirement so that you can enjoy life without having to worry about where the money for your needs and wants will come from? Now, as so often in money and finance, you'll have to make a few decisions at this point. Here are some of the key questions that come to mind. What's your time horizon for retirement? How much income will you need every month and year? What's your risk appetite for this phase of your financial journey? For example, should you go all in on income, safety, and predictability, or keep some exposure to equities and other assets that may distribute less cash and be more volatile, but also generate higher total returns in the long run? How concerned are you about inflation? How much do you want to leave to your heirs? This list is not meant to be exhaustive, and we can't answer all these questions for everyone watching today's video. But these are important questions that we would like you to keep in mind as we discuss our 7 safe and predictable building blocks for income. Your personal answer to these questions will influence which instruments you may ultimately decide to invest in. And for those of you who've already been through our Bond Beginners and Bond Masters courses, or who already have a strong foundation in bond investing and building a bond portfolio, I invite you to join me, Marcus, and our Diamond NestEgg members in our brand new VIP member community if you want to dive deeper into the 7 safe and predictable building blocks for income that we're talking about today, especially if income generation and income protection are top priorities for you this year, as rates are expected to move lower. Just visit our website at www.diamondnestegg.com and click on this yellow private VIP member community to grab your $100 early bird discount before we officially launch on January 15th. And check out part 1 of our members-only mini-series on corporate bond investing. For today, though, let's move on now to the most interesting part of the discussion. What are Diamond NestEgg's 7 safe and predictable building blocks for income that every investor should consider as the foundation for his or her portfolio? So, our 7 safe and predictable building blocks for income. These are the 7 investments that we think every investor should consider as the potential core for an income-producing portfolio. As I mentioned earlier, this is part 1 of our mini-series on how to build an income strategy in 2026. We'll be following up with a second video in the near future about additional income-producing investments that may generate some even higher yields, but that are a bit more advanced or complex. For example, collateralized loan obligations, REITs, and various derivative strategies. Now, some of our folks may like these options to diversify their portfolio, while others may not want to touch those with a 10-foot pole. But that's for the second video. For today, let's stick to the basics and dive into this table with our 7 safe and predictable building blocks for income. You wouldn't have expected us to do this without a table, right? I mean, what did people do before Excel and Lotus 1-2-3? So, in the first column, we have the name of the instrument, followed by the risk, whether the rates are guaranteed to maturity, and whether the instrument is considered liquid or not. Then we have a note about taxation when held in a taxable brokerage account. But please remember that taxes are not straightforward and that we're not tax advisors. Always consult with your trusted tax advisor about your personal situation. And of course, for each of these 7 safe and predictable building blocks for income, we'll also give you our thoughts about who should or should not consider an investment, as well as a snapshot of current rates. Because this video is about building a stable and predictable income stream for the long run, we generally will show the yields for the longest time period available, which is often 30 years, and sometimes even longer. This may or may not fit your retirement planning horizon, so you will need to adjust accordingly. Please keep in mind that these rates are indicative only, and they will also usually be lower if you decide to lock in your investment for shorter periods. And as we so often do on this channel, let's start with the safest and most straightforward instrument on top, U.S. Treasuries, and then move on to instruments that are either more risky or more complex, or in some cases, even both. So U.S. Treasuries, as we often discuss on this channel, are backed by the full faith and credit of the U.S. government, and their rates are guaranteed to maturity, meaning that rates are fixed and Treasuries are never callable. You can really lock in a rate with them. Treasuries are also liquid. In fact, they're generally considered to be the most liquid investment in the world, meaning that if you want to sell them before they mature, you should usually be able to find a buyer for your position quickly and at a reasonable price, although that price will depend on market conditions and does change over time. Interest on Treasuries is fully taxable at the federal level, but tax-exempt at the state and local levels. In short, Treasuries are as safe and predictable as it gets, and if that's what you're looking for, you will rarely go wrong with them. In the market, Treasuries are widely considered as the benchmark for any investment, meaning that their rates are what every other instrument is compared to. At the time of this taping, you can lock in a 4.86% yield for 30 years with Treasuries, which is not quite the 5% plus that many investors have in their mind, but still attractive when you compare yields for the 30-year Treasury over the past 20 years, as you can see on this chart here. If you want to get to a yield of 5% or more, then it may make sense to look at agencies and government-sponsored entities, or GSEs for short, our next instrument here on this table. Agencies and GSEs are either explicitly or implicitly backed by the full faith and credit of the U.S., which for retail investors like you and me means that for all practical purposes, we can consider them free of credit risk. They can offer slightly higher rates than Treasuries, but these are not always guaranteed to maturity. While their rates are usually fixed, many recently issued agency bonds are callable. Liquidity varies depending on the size of the bond offering, and some agencies and GSEs are exempt from income tax at the state and local levels, most notably those issued by the Federal Home Loan Banks, the Federal Farm Credit Banks, and the Tennessee Valley Authority, as you can see here in this chart from Bond Beginners. This 35-year bond from the Tennessee Valley Authority offers a 5.3% yield at the time of this taping on Fidelity. If that's what you want, this particular bond may be a good way to lock in the rate until maturity, as it is not callable. And on top, the interest will not be taxed at the state and local levels because it is issued by the Tennessee Valley Authority. If you like the safety and predictability of Treasuries but are concerned about inflation, then TIPS, Treasury Inflation Protected Securities, may be the instrument to consider. TIPS enjoy the same backing by the full faith and credit of the U.S. like any other Treasury, guarantee their rates to maturity, are generally liquid, and exempt from state and local taxes. TIPS might be for you if you like your investments as safe and predictable as it gets, but want inflation protection on top. At the last auction, the 30-year TIPS came with a real yield of 2.65%. For your annual payout, this means that the principal of your bond will be topped up every year by the current rate of inflation, and you will then get 2.65% of that growing principal paid out as interest in cash. As you can see here, the 2.65% on the 30-year TIPS are near 15-year highs. One more remark on TIPS. We are big fans of TIPS here at Diamond NestEgg for the inflation-protected part of our portfolio, but they are more complex, not least because they may trigger a phantom tax on the inflation adjustment to the principal if held in a taxable account. So make sure you understand how that works, as it may impact your cash flows. Bond beginners, folks, please refer back to Module 6 on TIPS for a refresher. Up next, we have SPIAs, or Single Premium Immediate Annuities. These, like all annuities, are considered very safe, especially if you buy them from one of the AA+ rated top insurance companies, like the ones we typically work with. SPIAs also come with extra protection from your state insurance guarantee association. However, limits are not uniform, so always check for your state. SPIAs guarantee their rates for life, but they're not liquid. Remember, once you're committed, you typically cannot access the original lump sum or cash the contract out. Taxation is split for SPIAs. A portion of the payouts will initially be considered return of capital and remain tax-free, but all income on top will be fully taxable. SPIAs are not for everyone, but they are one of the very few ways to create a guaranteed lifelong income to add to Social Security and a company pension. So, if that's for you, it may give you the assurance you need that you will never run out of an income, even if you live to 100 and beyond, which we're all clearly rooting for. Now, this same insurance feature of SPIAs, that they guarantee you an income for life, makes it very hard to compare rates. Whether buying a SPIA will turn out to have been a good financial decision or not in retrospect always depends on how long you will live. But if we keep that in mind, and also remember that SPIAs do not generally return any capital to the estate at the end, we can give you an idea for someone buying around the standard retirement age. Let's take a popular product as our example, a SPIA for life with a 10-year period certain, meaning it will pay you the guaranteed income for life, but has a minimum payment period of 10 years. So if you were to pass away before the 10 years, the remaining payments would go to your designated heirs. So the exact rates for a SPIA will depend on a lot of factors, including age, gender, state of residence, and more. And it's not fixed until you actually sign the contract. Here's a sample quote of annual cash flow rates from one of the leading insurance companies that we work with, meaning how much you will get in actual payments per year. 7.3% for a 65-year-old man and 7.1% for a 65-year-old woman, which translates into monthly payments of $611.46 for the male and $588.95 for the female per $100,000 investment. The gender difference in payments is reflective of the different life expectancies, of course. Next on our table are municipal bonds, or munis for short. Many, if not most, are investment grade, but it depends on the issuer and the bond type. And while defaults are rare in muni land, they have happened in the past. Rates are usually fixed and can be attractive on an after-tax basis. More about that shortly. But they are not always guaranteed to maturity, because many munis are callable after 10 years, which may or may not be that much of an issue depending on your time horizon. An estimated 50,000 state and local governments and other authorities issue municipal bonds, and often in very small amounts and staggered maturities. And as you can see here, at the time of this taping, Fidelity had 2,776 treasuries and 849 agencies or GSEs on offer on their platform. But at the same time, there were 156,690 munis that I could have chosen from. The sheer number of issues may feel overwhelming. This fragmentation also means that liquidity for most individual munis is low to potentially non-existent, although it might be a bit better for large issues. That said, quite a lot, but not all, munis come with one big advantage. Their interest may be fully tax exempt at all levels for in-state municipal bonds, munis from an issuer in your state of residence, which means you may receive your coupons completely tax-free. What you see is what you get. And even out-of-state munis, so not in your state of residence, are always exempt from federal income tax. You'll only need to pay state and local taxes on the interest, assuming your state collects them. This preferential tax treatment means that munis can be very attractive if you're in a high tax bracket and or in a high tax state and don't mind the illiquidity. AAA-rated 30-year munis pay up to 4.66% at the time of this taping, like this AAA-rated revenue bond from Clifton, Texas. Now, Texas doesn't collect a state income tax, but a resident in the highest federal tax brackets would still need to find a 7.4% fully taxable corporate bond to get the same net yield after federal taxes. This 7.4% being what the industry calls the tax equivalent yield. Do note, though, this bond can be called as soon as April 2034. And if you want to go up the risk spectrum a bit, this A-rated 30-year muni from the New York Convention Center Development Corporation carries a yield of 5.01% at the time of this taping. A New York resident in the highest tax brackets would need to find a fully taxable corporate bond with a 9.6% yield to get the same net income. Now, if you click through, it's not entirely clear whether this muni is not callable at all or whether it comes with a make-whole call. You may want to dig a bit deeper here in case you're tempted to lock this rate in. Up next, we have corporate bonds, or corporates. Similar to munis, corporates are issued by thousands of companies with a wide variation from AAA to non-investment grade. Depending on the rating, liquidity, and other factors, corporate bonds can offer attractive rates, but these are not always guaranteed until maturity. As most recently issued corporate bonds are callable, liquidity depends on the company and the issue. Usually, the bigger the company and the larger the bond issue, the better the liquidity. Corporate bonds are fully taxable at all levels. There's a wide variety of corporate bonds on offer for almost all preferences, but they require more time, knowledge, and engagement as every bond issue is different. If you can handle that, as well as the potential callability, there are some good opportunities out there, like this 5.47% yielding note from AAA or AA plus rated Apple that matures in 2062. So ideal for locking in a 5% plus yield for the long run, if that's what you want. Now, this Apple note is technically callable, but only 6 months before it matures, and even then has a make-whole call provision on top, which means that the yield is pretty much guaranteed for you. Remember that a make-whole call provision allows an issuer to redeem the bond before its maturity date, but at a price that compensates the bond investor for all future interest payments that will be missed. For our VIP community members who joined recently, please refer to part 1 of our deep dive on corporate bond investing if you want more details on the Apple bond we just discussed, and how to better understand Apple's financial situation. Part 2 will be coming out this coming week. And if you want to lock in rates for even longer and are not afraid of BBB risk at the lower end of the investment grade range, then this 2096 bond from Union Carbide carries a yield of 7.18% at the time of this taping. Now, 70 years is a long time, but even this 30-year BBB rated bond from Oracle here comes with a 6.95% yield and is only callable 6 months before maturity. And as a friendly reminder, corporate bond defaults have happened in the past. So if you decide to go down this route of buying individual corporate bonds, make sure that you understand and that you're comfortable with the company whose bonds you're buying, as well as their financials. In other words, whether the company, the bond issuer, has the ability to actually pay its bond investors the interest payments that are due on time and in full. And the last instrument for today's video is preferred shares, preferreds for short. These are hybrid securities. They're technically equities, but they pay a fixed coupon like a bond and don't come with voting rights under normal circumstances. Many issuers are investment-grade companies, including utilities and financial institutions, but the risk profile ultimately depends on the issuer, just like for corporate bonds. Preferreds do not guarantee rates to maturity. Yes, the rates are usually fixed, like with a coupon, but the issuer can suspend the dividend anytime without direct negative consequences. And such a suspension doesn't count as a default, like missing an interest payment on a bond would. That said, when we looked at the history of preferred dividend payments for a few sample companies a few months ago, we found that most companies have kept paying their preferred dividends fully and on time, even through difficult times, such as COVID. Preferreds come in many flavors, as we say here at Diamond NestEgg, and there are large variations between individual preferred shares, including on callability and convertibility. As always, make sure you understand the instrument before you buy. Preferreds are generally not very liquid, and not all brokers offer direct access to them, which is one of the reasons that some of our VIP community members prefer to invest in preferreds via a fund or ETF. So if you're a brand new VIP community member, please refer to these two preferred stock member videos to see whether a fund or ETF may be a better fit for you. And one more point on preferreds. If certain conditions are met, including the minimum holding period, and that the dividends are not just an attempt to repackage loan or bond interests, then preferred dividends may be considered as qualified and taxed to the long-term capital gains tax rates of between 0 and 20%. Depending on which federal tax bracket you're in, this may mean a tax benefit of as much as 17 percentage points, which is one of the reasons why preferreds may be attractive if you're in a high tax bracket and don't mind the fact that dividends are not guaranteed. Preferreds are also relatively illiquid and require a bit of work to properly understand and research. To give you two examples from regional utility companies, we found this A-rated preferred from Entergy, Louisiana, with an annualized dividend yield of 5.9%, a federal tax equivalent of 7.11%, assuming the dividends are classified as qualified. Or this one from Massachusetts Electric Company, which is rated BBB at the very low end of the investment grade range, but shows an annualized dividend yield of 6.78%, equivalent to an 8.17% yield based on the difference between the top rates for federal income taxes versus long-term capital gains. So there you have it, an overview of our 7 safe and predictable building blocks for income that every investor should consider for the foundation of his or her portfolio, which leads us to the next section of this video. What's our perspective? As you can see from this table on our 7 safe and predictable building blocks for income, there are quite a lot of options to choose from when it comes to income strategies. And that's even before our next video, where we will look into investments that may generate some even higher yields, but that are a bit more advanced or complex. So to bring this all together, let's go back to these 5 questions from earlier, because your answers to these questions will help you narrow down your options. So for example, if your time horizon is short, perhaps because you're already many years into retirement and your risk appetite is low, you may want to stick to Treasuries, agencies, GSEs, and or single premium immediate annuities. On the other hand, if you have a longer time horizon, say you're like me and Marcus, and your risk appetite is a bit higher, corporate bonds and even preferreds may be a better choice for the fixed income part of your portfolio. And if you're in one of the highest tax brackets, plan on holding to maturity and do not necessarily have an issue with callable bonds, I would certainly suggest looking at municipal bonds because the tax equivalent yields on those make them quite attractive in my mind. And remember, it's never all or nothing when it comes to investing. I know that many of our Diamond NestEgg regulars and members started on this channel with us learning about I-bonds and T-bills. Some still own just I-bonds and T-bills because that fits their personal situation. while others have gradually added a little more risk for more return as they better understood the fixed income products in the market, whether that may be via agencies, munis, corporates, REITs, or even CLO ETFs, such as JAAA, Janus Henderson's AAA CLO ETF. There are always trade-offs to be made in life. Your financial and retirement journey is no different. And at some point, you will need to decide how much risk you're willing to accept for higher yields as T-bill rates come down. And these trade-offs can sometimes be confusing and overwhelming. So again, if income generation and income protection are top priorities for you, we invite you to get early access to a brand new VIP member community, which will be officially launching on January 15th. In addition to your top-of-mind Treasury and agency bond questions, we'll also be diving deeper into higher-yielding income strategies such as corporate bonds, high-yielding bond funds, covered call strategies, preferred shares, and principal protected products during the coming year. We've barely scratched the surface in today's video on all the income-generating strategies out there. Just visit our website at www.diamondnestegg.com and click on this yellow private VIP member community button to grab your $100 early bird discount and check out part 1 of our members-only mini-series on corporate bond investing. And see what our Diamond NestEgg VIP members are already talking about in our new member zone in the new year. I've included all the links below this video for you as well. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed today's video and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.